Good morning, everyone. Or good afternoon, as the case may be, depending on where you are. This is the day 8 of the workshop, and today we are continuing from a new beginning where we will be talking about group accounts. And we laid a foundation yesterday, which was the second section in day 7, which was the foundation of understanding what intercorporate investment is all about and what form of intercorporate investment results in the recognition of group accounts, or such that brings about business combination, and what form of business combination results in the preparation of group accounts. Okay, and if you remember, yesterday we perused the following, which I will show on the screen. Where we started with accounting for business combination, what constitutes a business combination, what is a business, and we defined business combination with respect to IFRS 3. And furthermore, we went to look into typical examples of how a business combination is carried out. And on the premise that all the businesses or all the entities involved qualify as a business. And we went further to discuss on forms of business combination by way of acquisition and merger. And we also went further to the accounting methodology for business combination, which is the acquisition method. And also we went further to define what control is. And we define what control is from 2 perspectives. The first perspective is on the presumption, and second perspective is on the substance and the reality. And that led us to the requirement of what constitutes a group, and what then they will regard as group accounts. Okay, that is where we are. I want Olawale to say 1 or 2 things about what we discussed yesterday in 2 minutes, and we'll continue from there.
So we talked about business combination, and we said is a coming together of 1 or more businesses to form a new entity. It is also form a new entity. We also spoke about the advantages of 2 or more businesses coming together, which is brings about competition, brings about expansion. We also mentioned one of the disadvantages will be that it causes monopoly. If 2 or more businesses come together, to bring about a form of monopoly, and there will be adverse effect on the customers in terms of high prices and all. We also talked about what a business is, and we mentioned 3 key criteria of what a business is, which is input, process,
your network is bad,
and output. We also spoke about what a business is, and we mentioned 3 key concepts, which is input, output, and input process equal to output.
Hello?
Did you get me, sir?
Yeah, we can hear you.
Did you get me, sir? Okay, so
we can hear you.
all right, going forward, we also mention the method of accounting for business combination, which is acquisition method. We also spoke about equity method, but didn't go into detail because that will be discussed in the further classes. That's my submission.
I think we're okay. Thank you very much. Okay, now let's start the discussion today with this. Okay, the first thing we need to understand is that group accounts is only required when we have a group. Okay, and we have a group only when we have a relationship between two entities that is considered parent-subsidiary relationship. Okay? Hello, can you hear me?
Yes, sir. Yes, sir. Yes.
Okay. Okay. Now, and when we have a group, and within the group, control exists, and control resides with the parent. And what that presupposes is that at every point in time, we have such a situation where we have two members in a group at least, and of which one controls the other. The party that controls is known as the parent, while the party that is subjected to control is known as the subsidiary. Remember, we defined control yesterday as the power the investor has over the investee, such that it exposes the investor to variable returns in the investee. And in that situation, the exposure to variable return in the investee is as a result of the involvement of the investor in the investee. And such that this shows or gives the ability of the investor to make use of his power over the investee in a manner that affects the amount of return that the investor gets from the investee. Now, if such a control exists, it's at that point we are required to prepare a group account. A group account is like a tradition, such that at every reporting date, you prepare group accounts. And who prepares group account is the parent. Because the parent, in addition to preparing his own separate financial statements, has additional responsibility to prepare group accounts. And we said group account is the account of the parent and that of the subsidiary, as if it is accounts of a single economic entity. Now, as I have said, a group comprises of the parent and also the subsidiary. And if there are more than one subsidiary, we say subsidiaries. Okay, in that light, the first thing I want us to look out for is what structure can a group take? Which means we have various structures within a group. And I want to show us with this. The structure a group take could be any of this form. I'm coming. This is what the structure looks like. The structure of a group can be a simple group, and the structure can be a complex group. Now let's look at a simple group. A single group structure will come in two variants. The first one is that you might have a group where you only have two members. One is a parent, the other is a subsidiary. You can also have a group that has more than two members, starting from 3 members to 4 and etc. But the uniqueness of such a group is such that there is a parent, while every other members other than the parent are subsidiaries. And these subsidiaries are considered fellow subsidiaries because It's only the parent that brought them together. None of them have relationship with one another other than the relationship bounded by the parent. Okay, which is what you see here in this case. This is a single subsidiary. This is where you have multiple subsidiaries of which none are stake in another, but all of them are subjected to the control of the parents. We can equally have a complex group. In a complex group, we have two types. One would be what we call indirect subsidiary. What it simply means is that the parent has a subsidiary, and the subsidiary itself has a subsidiary. In that light, we can consider that since the parent controls subsidiary A, and subsidiary A controls subsidiary B, invariably and indirectly, parent controls subsidiary B, which means in this slide, I can say subsidiary A is a subsidiary of parent, and subsidiary B is a sub of the subsidiary of the parent, which means it's a subsidiary of subsidiary A, and subsidiary A is the subsidiary of the parent. That's what it means. Lastly, we have the mixed group. The mixed group is a situation where you have at least 3 members of a group, of which the subsidiary and the parent equally have interest in another subsidiary. Look at this scenario. The parent has subsidiary A. Okay, jointly, both the parent and subsidiary A has interest that gives control, in subsidiary B. Invariably, subsidiary B will be seen as a joint subsidiary of parent and subsidiary A. Now, from this structure, you can have multiple layers that can be created. And that's what we are talking about. But the foundation of any structure within a group is premised on these 4. Be it a single subsidiary, be it fellow subsidiaries, be it an indirect subsidiary, and be it a joint subsidiary. Any of these shapes can take preeminence as we move on. Any question? Any question?
What's the major difference between holding indirect and mixed group?
Okay, see the difference here from the diagram. The parent itself does not have 1 naira invested in subsidiary B. But subsidiary B is indirectly a subsidiary because he owns subsidiary A that owns subsidiary B. Or he controls subsidiary A that controls subsidiary B. It's like I have a father, my father has a father. Okay, I'm not the child of my grandfather directly, but I'm the child indirectly because he gave birth to my father. Are you getting it now? But in this case here, this parent owns or controls subsidiary A. Collectively, this parent and subsidiary A jointly invest in subsidiary B. Can you see this arrow?
Yes. Yes.
Which means there are 2 investors here. Parent and subsidiary A are investors in subsidiary B. And that's what it means. You can see what I said here. A mixed group entails a parent and a subsidiary having a common interest that gives control in another subsidiary. Whereas here, you have a situation where a parent has subsidiary and the subsidiary equally has a subsidiary in which the parent has no direct
interest.
Does that mean?
Yes, sir.
Okay. That is that. Now, we have defined control. But again, we need to emphasize that what makes a company a subsidiary of another, or what makes a company a parent of another, is the existence of control. Now, let's go back and evaluate control. Control is a key word at any point in time. Okay? And what is control in its real sense? We said control of an investee. An investor controls an investee when the investor is exposed or has a right to be able to return from his involvement with the investee and has the ability to affect those returns through his power over the investee. That is control. Prior to now, under IAS 27, we define control as the power to govern financial and operating policies of an entity so as to obtain benefit from its activities. But control has gone beyond that. Okay, now, these are terminologies that we are going to be familiar with. We'll make use of some of them. And as we move on, we'll more or less come across some other ones. Okay, we know what a group is. We know what a parent is. We know what a subsidiary is. We know what constitutes a business combination. And we know what constitutes consolidated financial statement, which is otherwise known as group accounts. We've defined control. Other ones will come across them as time goes on. The only thing I've done in the text is that the text has more or less brought some key terms all together to define them. But we are not going to go by way of just trying to define, no. Once we get to each bridge, we'll learn how to cross it by familiarizing ourselves with those terminologies and of their essence. Okay, now what matters now is let us expose ourselves to the basic principles of preparing group accounts, which I can simply call the mechanics of group accounts. Now, we will share our notes, and that is our whiteboard, and we'll start and continue from there. Now, let us look at this illustration first. When we say group accounts, okay, we are talking about the financial statement of a group, which means the financial statement that has combined the results of the parent and subsidiary in such a manner that depicts the result of a single entity. Now, how do we do that? We do that by way of a line-by-line consolidation of like items, which means if you pick the balance sheet of a subsidiary and that of the parent, classes of assets that align with one another are consolidated. The word consolidation means combining the account of A and B subject to some level of adjustments. Okay, it is the adjustment that make it a consolidated account rather than a combined account. Remember, in the conceptual framework, we discussed about combined accounts. And now we are going to see how consolidated accounts may vary from a combined account. Okay, now when we consolidate on a line-by-line basis, and we are going to see that as we move on. Now, when we are to prepare a consolidated financial statement, we are also going to prepare it in line with IAS 1, which recognizes, alongside with this conceptual framework, which recognizes the five components of financial statements, namely the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flows, and the notes to the financial statements. The only difference here is that these statements will be qualified with the term consolidated, which means our emphasis to financial position of a group will be to call it consolidated financial position or statement of financial position. For the statement of profit or loss, we call it consolidated statement of profit or loss. And this is how we do that as we move on. But the first level we consider at this primary level is how do we proceed to consolidating the statement of financial position of the parent and of the subsidiary. Now, the first level I will introduce us to is that a subsidiary can be wholly owned and a subsidiary can be partly owned. What do we mean? A wholly owned subsidiary is a subsidiary that only have a single shareholder, and the shareholder is a controlling interest, which means the shareholder is a parent. But a partly owned subsidiary have at least two shareholders, in which one is the parent, while others may be considered the non-controlling interest. Why? Because the parent is the controlling interest in a subsidiary. Every other shareholder, whether it's a single shareholder or group of shareholders that account for the other parts, those shareholders will be collectively grouped and considered as non-controlling interest. And for short, we call it NCI. Okay, but in real life, it is known as non-controlling interest. And likewise, in the examination, you must be emphatic about it by stating it categorically as non-controlling interest. Okay, but in the course of this discussion, we can usually call it NCI. Okay, that is that. Okay, let us look at the first level that will expose us to the process of consolidation. And to do that, I'll more or less borrow from this illustration. I'll try and cut this and put it on our whiteboard. Now, I'll share my whiteboard screen now. Mr. Nwokocha is a new member. Can we see your face, please? Put up your camera. Now, I've cut it and pasted it here. Welcome.
Good afternoon, everyone.
Good afternoon, sir.
Yes, sir. Thank you very much, sir. Good afternoon.
This is the first.
This is my face.
Yeah. Thank you, sir. Okay. Now, this is the first principle that will lead us to the process of consolidation. Okay, and I want someone to read this. Madam Anna, can you read this for us?
First principle.
We can hear you well.
Okay. The first principle. Is it better now?
Yes, ma'am.
Okay. 100% ownership of the subsidiary by the parent. There are situations where an investor company owns all the voting rights in an investee company through ownership of the entire shares of the latter. In this situation, the subsidiary is said to be wholly owned by the parent company. 100% ownership of a company by the parent in another company in the subsidiary will not give rise to non-controlling interest, formerly known as minority interest. We can explore the principle of consolidating a wholly owned subsidiary by adopting this illustration. Illustration 1. The consolidation of the statement of financial position of the dual companies, parent and subsidiary, with 100% ownership of the shares of the subsidiary by the parent can be illustrated with the hypothetical scenario as shown below. Company P acquired 100% of the equity shares of Company S on the 31st December 2015, which is the reporting date for the dual companies. The statement of financial position of the two companies on this date stood as follows. Statement of financial position as at 31st December 2015 for P and S. Property, plant, and equipment for P, we have 300 million, and for S, 130 million. Investment in shares, we have for P 180 and for S new. Current assets, we have 120 for P and 70 for S. Total assets for P, that's 600 and 200 for S. Share capital and reserves. Equity share capital at 1 naira per share. For P, we have 400 and for S, we have 120. Reserves, that's retained earnings. We have 120 for P and 60 for S. Total, we have 520 and 180.
Okay.
When you less it, we have 80 and 20. Is that all? There's one left. For current liabilities. Okay, I think that's all.
Yeah, add it, finish it.
Okay. Then for current liabilities, which was what I just said, for P and X respectively, 80 and 20. So when you total everything together, you have for total equity and liabilities, you have 600 for P, and for S, you have 200.
Okay, thank you very much. Yeah, thank you very much. Now, okay, I believe you all have the material beside you. Okay, if you have not gotten your material or you don't have it at all, please, I've told you to contact me, and nobody contacted, which means most people have gotten it, except for those that newly joined yesterday and today. Okay, but take note of this material, this information. We'll be referring to it. That's why I've cut it and pasted it here. Now, the first thing you do is that we put up our group structure. What is our group structure? A group structure is to identify who are the members of the group. Let's assume the group is in this cycle. In this question, we have two members, P, and we have what? S. And P controls what? S. Now we are told that P has 100% stake in S, which means invariably it has 100% what? Stake. In this case, the subsidiary let me write it clearly because I'll still share the notes with you. The subsidiary is wholly owned. And when it's wholly owned, it means there's no non-controlling interest because it's a single shareholder. Now, the next question we ask ourselves is, when was the date of acquisition? From the information, acquisition took effect 31st of December 2015. The next question we ask ourselves is, what is our reporting what date, which is otherwise known as the date of consolidation. And from the information here also, we are presented with a position in this date, which we are told to consolidate, which is the same date. Now, the first order we cross is, what is the date of acquisition? Alternatively, you can hear what we call date of inclusion. Now, let's take us back to this, and this is how you make use of the material. Remember, I told you that there are some terminologies we'll be making use of. I will start to make use of them. When is the date of acquisition? You can see it here. Acquisition date is the date on which the acquirer obtains control of the acquiree. I will analyze it because it looks straightforward, but in some instances, it may not be straightforward, and I will explain. Date of acquisition is very simple if the acquisition is straightforward. That is, if you buy a subsidiary, buy over subsidiary today and you pay today, everything is agreed today. Your date of acquisition is where that exchange took place. But in the long run, acquisition might take place on a piecemeal basis. What does that mean? It simply means that I might first of all add some little investment. I add to it over time, or to a point where I now gain control. In that instance, it will be straightforward. But what simplifies it all is that date of acquisition is primarily defined by the date in which you obtain the control, which means the final date to which you have the power over the investee, and you run with that power is your date of acquisition. But in this simple case, the date of acquisition is very straightforward, which was given to us as 31st December 2015. Your reporting date is the date of the year end in which you are to present your financial statements. But at this point, probably we are acquiring this company as at our year end. And therefore, after the acquisition, we want to ask ourselves a simple question. How do we account for it in line with the requirement of IFRS 3? Because acquisition date accounting is the requirement of IFRS 3. Now, to do that, 1 minute. Okay. Now, how do we consolidate? The group belongs to P. We'll call it P group. And because we are consolidating, you must qualify the statement as consolidated before you consider the statement of financial position. All figures are in millions. Now remember, in line with IS1, you have your assets, which is broken down into non-current assets. Now, what is the first item there? The first item there is property, plant, and equipment. 300 and 130. Property, plant, and equipment. We have 130. And sorry, 300 and 130, sorry. Which is what? 430. Okay, next, we have investment. This investment, I'm going to put it in green. And anything I put in green, let us set it aside. Set aside. Why are we doing that? I will explain. Therefore, what is next is current assets. Our current asset is 120 and 70. $120 and what? 70. That's what? 190. All in all, what do you have? 620. And this 620 is what we refer to as our total assets. But remember, something is missing between these two, which we are yet to explain. Also, we are aware that total assets is financed with what? Equity and liability. And equity comprises of share capital and what? And reserves. And share capital, if you go back here, we have share capital. We have share capital for P 400 and we have share capital for S 120. Remember, I want to circle this 120, which is the share capital for S. Remember, anything we put in green circle is set what? Aside. Why are we doing that? Is a question that begs for an answer, which we will do. Which then means that what is left out is the 400, which I will account for. The same way I've accounted for 120 and 70. Therefore, I come here, I say I account for that of P only as capital. And that is how much? That is 400. Reserves. I have reserves. For P is 120, but for S is 60. That too, because I circle it in green, I set it what? Aside. Why am I doing that? It begs for answer. What I'm left out with is the reserve for P. I'll also emphasize here for P only. And that is how much? 120. That gives me 520. This 520 is what I call my total equity. What is next is current liability. Okay, I have 80 and 20. Current liabilities, I have 80 and 20. That is what? 100. All things being equal, I have what? 620 as my total equity. And liabilities. Okay, now I have a problem. What is the problem? Is that 3 things have been set aside. Let me bring them out. Three items set what? Aside. And what are the 3 items? One is the piece investment in S, which sum up to 180 million. 2, share capital of S, which sum up to 120 million. 3, reserves of S, which sum up to 60 million. These are the 3 things I've set what? Aside. Even though I set them aside, but it seems nothing was wrong. But I'll tell you something about financial reporting. Mere having coincidence or getting something does not make it right if you cannot justify it or explain it. Therefore, what is the issue there? That will lead us to first principle. First what? Principle. What is first principle? The first principle is the principle of consolidation. And what is that? The principle is such that you want to cancel out the following. Assume all figures in millions. First, you need to ascertain the cost of business combination. What does that mean? What it simply means is, what is the investment? When I say investment, equity investments made in S. And that investment is this item that P made to gain 100% ownership. 180. I bring it here. This cost of business combination is what I want to offset or cancel out with the net assets of S that was acquired at the date of acquisition. And I'll take you through a journey. What is the journey? You know, with this conceptual framework, recall the accounting equation. What is the accounting equation? That says assets equal equity plus what? Liabilities. And if you recall, an asset and a liability have something in common. What do they have in common? What is common is that this brings about positive economic what? Benefits. This brings about what? Negative economic what? Benefits. Which means one generates benefits, the other consumes benefits. Now, what do we need to do? Collect like term. What are the like term? Asset and what? Liability. Therefore, what will I do? I bring back assets. When I take liability to cross the border, it becomes what? Negative. Which give me what? Equity. I can call that equation 1. Secondly, if I net this off, it could either be net of assets if the amount of asset is more than the amount of liability. In this case, we say my equity is positive, which is the equation 1. Or if my asset falls short of liability, which means my liability is more than asset, is it net of a liability, which means my equity is what? Negative. You barely see this second position because this position depicts a going concern problem. Okay. Now, to move further, let us assume it's net of assets, which we call net what? Assets. Okay, what then do we do? We say net asset equal equity. I remember equity is made up of what? Capital and what? Reserves. Which means if that is the case, I'll say this is the left-hand side of the equation, and this is the right-hand side of the equation. And what happens to the left-hand side? In the left-hand side of the equation, what happens there? What happens here is that consolidation takes place here. But what happened to the right-hand side? This is where cancellation takes place. And what are you canceling out? You are canceling out the capital and the reserve, all at acquisition what? Date. And which is what we are trying to do here. Left-hand side are the assets and liabilities, which you can see here, the assets and liabilities. What are we canceling out is what you can see in green, which is the share capital of S and the reserves of what? Of S. All of this is as at acquisition what? Date. And this is how much? From the information we have here, 120 and what? 60. And when you add it together, it gives you what? 180. Now, what can you deduce here? Is that this totally cancel out this, leaving out what? Is 0. That is what it means by the time you offset it. Now, it is because we have canceled out this by way of an operation. That is why we are not consolidating, which means the result of the subsidiary is such that you consolidate the asset and liabilities of the subsidiary with that of the parent, but you cancel out its share capital and the reserve as at the date of acquisition, which means we never set aside. We only set it aside to carry out this first principle as an operation, which has totally canceled out. And what this signifies is that you parted away with, as a business, P parted P paid the whopping sum of 180. Let us say in cash, for example. Why in return? In return, it got assets and what? Liabilities. What are the assets and liabilities you got? Sorry, it's clear now. P paid the sum of 180 million, let's say in cash or in kind. And here, P took over the assets and liabilities of S as thus. One, it took over PPE. How much was the PPE it took over? The PPE took over was 130. 130. The current asset took over was what? 70. And the current liability assumed was what? 20. Therefore, what do? I don't know why this keeps going off. P took over the assets and what? Liabilities of what? S as thus. PPE 130. Current assets 70, which means the total asset taken over is 200, less the liability assumes. It took over liability, which means it will pay the liability on behalf of the company, 20. Which means net. What it took over is 180, which is a net worth asset. And this 180 is as represented by this equity. Remember, because of this equation that says net, the net assets will be equal to the capital and the reserve, which is what we have here. The net asset of 180 as at acquisition is equal to the share capital as acquisition and the reserve as acquisition. That is what it is here. Any question? Any question? Now, this is the foundation that we are laying today. Any question at this point?
The net asset of X acquired, share capital 120, reserves 60. That's gotten from the question, right?
Yes. That is it here. Can you see that?
Yes, so 120. Okay, so yes.
You saw it?
Yes, sir.
Okay, now let's go to where it is not wholly owned subsidiary.
So, sorry, sir. What did you do with that? Okay.
I can't hear you.
What did we do with the 400? The 400 is the equity in P.
Which 400?
You can go back a little, sir.
Where's the 400? This 400 here now. That is the equity we have here now. We didn't do anything.
Okay.
It is the 400. Does it make sense? Are you clear? Let me show you. Let me share the screen. This is the 400 here. Can you see it now? Am I not sharing it? Can you see the 400? Olawale?
All right.
Can you see the 400?
On your screen, sir.
Can you see the 400? Okay, I think his network is bad. Okay, now let's now look at the next question. Our new member for today, where is he? I think his network is bad, he has gone. Shagun, can you help us read where we have, where it is not wholly owned, it is partly owned? This situation, can you read this for us? Second principle.
Okay, second principle, less than 100% ownership of the subsidiary by the parent. In most of the cases in the group, the ownership interest of the parent company is sometimes and usually less than 100%, which means wholly owned subsidiaries are less common to partly owned subsidiaries, where part of the ownership interest in such subsidiaries is attributable to non-controlling interest. Non-controlling interest exists only where a subsidiary is partly owned by the parent company, and the value of the non-controlling interest should be ascertained and shown as part of the total equity of the group, but classified under separate head, which is known as equity attributable to non-controlling interest in the consolidated statement of financial position. IFRS 3 revised establishes the principle for recognizing and measuring the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. Any classifications or designations made in recognizing these items must be made in accordance with the contractual terms, economic conditions, acquirers' operating or accounting policies, and other factors that exist at the acquisition date. Each identifiable asset and or liability is measured at its acquisition date fair value. Non-controlling interest in an acquiree, non-controlling interest in an acquiree that has present ownership interest and entitles, non-controlling interest in an acquiree that has present ownership interest and entitles their holders to a proportionate share of the entity's net assets in the event of liquidation are measured at either fair value or the present ownership instruments. Proportionate share in the recognized amounts of the acquiree's net identifiable assets. All other components of non-controlling interest shall be measured at their acquisition date fair value unless another measurement basis is required by IFRS.
Okay. Thank you very much. Okay, let me now give you the question. Okay, you can start with the technical note.
Okay. Technical note. In a business combination achieved by contract alone, the acquirer shall attribute to the owners of the acquiree the amount of the acquiree's net assets recognized in accordance with the IFRS. In other words, the equity interest in the acquiree held by parties other than the acquirer are a non-controlling interest in the acquirer's post-combination financial statements, even if the result is that all the equity interests in the acquiree are attributable to the non-controlling interest. We can explore the principle of consolidating a partly owned subsidiary by adopting the illustration 2. Pali acquired 80% of the equity share capital of Suzy on the reporting date 31st December 2015. The statement of financial position of the two companies on this date is as shown below. Financial position as at 31st December 2015. Pali has a property, plant, and equipment of 300 and Suzy has 130. Pali has investment in Suzy of 144. Pali has current asset of 120, Suzy has 70. So the total asset for Pali is 564 and that of Suzy is 200. Pali has equity share capital of 400, while Suzy has 120. Pali has reserve or retained earnings of 84 million, while Suzy has 60 million. So the total equity for Pali is 484 and that of Suzy is 180. Current liability for Pali is 80, that of Suzy is 20. Total equity and liability for Pali is 564. Total equity and liability for Suzy is 200, and all figures are in million. In order to consolidate the statement of financial position on the parents, Pali, that is Pali, and the subsidiary. Okay.
We now want to look at the problem and we'll solve it. Okay. Now, how do we attempt solving the question? Remember, the steps are iterative. The first step again is the structure. What is the structure of the group? The group structure. Pali and what? Suzy. What stake does Pali have in Suzy? 80%. I mean, that means that there are other investors outside the group who collectively have 20% because investment should be 100% owned, but 80% owned by parents. It then means that the other 20% is owned by non-controlling what? Interests. This is non-controlling interest. Now, when was the date of acquisition? and when was the date of consolidation? It's not different from what we've had before, that the acquisition took place as at the reporting what? Dates. Okay, which means the 2 dates are the same. 31st December 2015, and we're also reporting on that date, 2015. Given that light, now since we are aware of the first principle, we'll go by way of the first principle, which is the principle of what? Cancellation. Yeah, let's go ahead and cancel. All figures are in millions. We start with the cost of business combination. In this case, there are 2 investors, the parent and the NCI. But in the first case, there's only one investor, which is what? The parent, because it is wholly owned. Therefore, what has happened? It means the cost of combination is coming from 2 sources. One comes from P, which is PALI in this case, investments in S. 2 comes from what? NCI, investment in S, which means we need those 2 amounts. And if you remember, what do we use to cancel out the cost of combination is the net assets of S, in this case, Susie, as at the date of what? Acquisition. I remember from our explanation up here, the net asset is viewed from the right-hand side, which is capital and reserve as at the date of acquisition, which is what we replicated here. Which that means I need the share capital of Susie and I need the reserve of Susie as at the date of acquisition. And how do I get that? I get that from our accounts. If you remember, I need it. This is 120, and this is what? 60. Those are the items I move there and say share capital, which have to be canceled out. 120, and reserves of Susie, which is what? 60. These 2 are as at the date of what? Acquisition, which sum up to what? 180. Now, what I need is X, which is Pali's investment in Susie. What is Pali's investment in Susie?
44.
If you go by the question, Pali's investment in Susie is this amount, 144. I come here, I cancel this X, I replace it with what? 144. Why? I don't know what it is. That will lead me to second principle. And what is second principle? Is how do I account for non-controlling interest, which is NCI, as at acquisition % in a company as a non-controlling interest holder. The question you ask, if somebody tell you what is your worth in that business, the first thing you ask yourself is that I have 20% stake in that business. Second thing you ask yourself is, okay, what is the value of that business? If the value of the business is 1 billion, I can now tell that person comfortably that my worth in that business is 20% of 1 billion, which is what? 200 million. Which then means that value of NCI will be equal to the proportionate share of the NCI in the value of the subsidiaries' net worth assets as at date of what? Acquisition. If that is the case, what is your proportionate share? 20%. The next question is, what is the value of the company as at that date? It is valued based on the net worth asset, which is 180. Therefore, this 180 is what I bring here. Which means 20% of 180 will give me what? 36 million. What that simply says that, okay, assuming that when you took over, look at the things you took over, or look at the asset and liabilities of subsidiary, 130, 70, and liability of 20, which means if you take your 20% stake, 20% stake, 20% stake, what do you have? 20% of 130. 20% of 130 from my calculator here to give me 26 plus 20% of 70 should give me 14 minus 20% of 20 should give me 4. And at the end of the day, what is my net worth? 36. That's what we are trying to explain. Which means 36 is what it is, my Y. And I can come here and say, my Y is 36. Now, 144 plus 36 give me what? 180. As usual, this cancel out this, and this is what? 0. Which means invariably, I can come here and show my balance sheet and say the group belongs to Pali. Pali Group. Assets, non-current, I have property, plant, and what? Equipment. What is mine? I have 300 and 130. That is 430. Investment has cancelled out. What is left is current assets. What do I have? I have 120 and 70. That's 190. All things being equal, I have my total assets. To be 620. Next, I have my equity and what? Liabilities. And equity is made up of share capital and reserves. The share capital is for PALI only. Why? Because if you go by this, we've taken away the share capital of this, which means what is left is 400. The reserves is also PALI only, which is 120. No, sorry, 84. Sorry, 84. That's 484. They give me equity of PALI. Before, this will have been total equity, like in this case. But it is not total equity here because remember, we only account for 80% stake in Suzy, which means we still have other equity holder, which is the equity attributable to non-controlling interest. If you remember, that equity is how much? 36. This 36 million is what I have here, would give me how much? 520. That is my total equity. Before I consider my current liabilities. What's my current liabilities? From the question, I have 80 and 20. 80, 20 will give me what? 100. That give me what? 620. And that 620 is my total equity. And what? Liabilities. $620. Okay, that is that. This is the basic of consolidation, which is what we wanted to discuss today. Okay, the basic of consolidation. Any question at this point? Any question at this point?
I have a question.
Yes.
What the rationale? Hello. Can you hear me, sir?
I hear you, sir.
Yeah, the addition of non-controlling interest to the group. That's what I didn't understand very well. They're not controlling instead of that 20% of equity.
What you are saying is simple, which I can highlight. You are saying, why this? Why this? Is that not what you are saying? The question then is, what is non-controlling interest? You can't see the screen. Can't everybody see the screen? I can see it from another.
The full screen.
Can't you see?
It's not full to the last aspect that you are talking about.
It is there.
Yeah, you can see it now. Yeah, you can see it now.
I can help you enlarge it.
Not
Let me enlarge it. Let me enlarge it.
You can see it now.
Now, this 36 you are talking about, the question then is, do we understand what non-controlling interest is? Let us go back and try to redefine what non-controlling interest is. What is non-controlling interest? Can you read it, sir? Yeah. Let me enlarge it. What is non-controlling interest?
The non-controlling interest, the equity. That's it.
Okay. Can you read it?
It's, I can't see it again. You can, it's, okay.
Yeah.
Yeah, it's okay like this, please. It's okay. Non-controlling is the equity in a subsidiary, not attributable.
I think your network is bad.
Your
network is bad. We can't hear you. Somebody else could read.
I can hear you. Okay.
No, it's breaking from outside. Can you read?
Okay.
Non-controlling interest, the equity in a subsidiary not attributable directly or indirectly to a parent, also as a proportion of net assets of a subsidiary entity that belongs to investors outside the group.
Does that clear your doubt now, sir?
Yes.
Okay. Thank you. Any other question? Okay, that speaks to the volume of what we want to discuss. Okay, on how do we consolidate? There are three basic principles, but today our discussion lies with two principles. The first and the second principle of consolidation, which is otherwise known as consolidation mechanics. Any other question before we call it a day? Okay, in the absence of no question.
Sorry, sir, can you please just to run through question 2 again? Not solving now, just to run through it. Especially those ones that we colored red. Just
everything we did in question 2 is exactly the same thing in question 1. The only difference is that we are now saying that the stake parent has is not 100%. If it's not 100%, how do we now account for the portion that does not belong to the parent, which we describe as a non-controlling interest? And we have said the non-controlling interest is the equity portion of a subsidiary that is not directly or indirectly attributed to the parents. And this 20%, the way we account for it is to say what is the worth of the business as a whole, which is the subsidiary. Find 20% of it, which is the value that is due to the non-controlling interest, or because the subsidiary was not owned 100% by the parent. And the portion of that is what we account for as part of the equity, which means total equity will always be subdivided into two: equity due to the parent and equity due to the non-controlling what? Interest, to the extent of what they owed in the subsidiary. Any question?
Sorry, I have another question.
Yeah, what's your question?
Will there be any change if the acquisition date is different from the consolidated date? Consolidation date?
The first thing you need to understand is that we said we must start from the spot. You understand? It's a long journey. This journey is the simplest journey you can ever come across, which means the day you acquire is the day we are doing accounting. The next order we cross is that, okay, what about if a year has passed? What about 2 years has passed? What is the implication? Which is the next phase of the journey. Remember, it's a journey. Okay, but a journey of 1,000 miles begins with a step. And the first step is what we have considered, the first principle and the second principle. Maybe when we get to the third principle, we start to unveil certain new dynamics. Any other question? Okay, in the absence of none, we call it a day. Thank you very much, and God bless.
Thank you, sir.